Good evening, participants. Good evening, participants. Good evening, participants. The most expected webinar will be starting exactly another few minutes. So just give us a 1 or 2 minutes time. So we will update you with the other details. Good evening, participants. May I know the audio quality? If any issues with the audio quality, please type in the chat box. Please respond me. How about the audio quality now? Thank you. Good evening, participants. Welcome to the webinar on tax deducted at source in GST. My name, Shilo Rao, General Manager, Capacity Building, National E-Governance Division. On behalf of National E-Governance Division, along with my team members, Shalini and Ashish, we are hosting this webinar. So let me introduce the speaker of this today's webinar, Shri Rajiv Agarwal, Senior Vice President, Outreach Capability Building, GSTN. Mr. Agarwal is an IRS officer of 1995 batch, and he has been an alumni of IIT Kanpur. He holds BTech degree as well as master degree from IIT Kanpur. He has been in government service in the prestigious IRS cadre, and he's been a strong person to move and implement the GST across the nation. So before going into the webinar, I request my colleague Shalini to brief you about the housekeeping instructions. Shalini?
Hello everyone. A very good evening to each one of you. First of all, very thank you for you to taking out time and attending this webinar. There are a few housekeeping rules which we have to share, which we request each one of you to follow as said. There is one chat box here, which is there available for each one of you. For any technical glitches or any technical assistance, we are here for you. You may put your questions there. The session is timed for 30 minutes. At the end of 30 minutes, we will be in a position to take the questions from you. However, the questions will be answered only at the end of the session. Each questions we will endeavor to answer it with the respect of time, how many we are able to, we will. And the time that we have kept for the answers for the questions we may receive during the presentation is timed for 15 minutes. Hope you have a good learning from this session. All the very best. Happy learning. I would now invite Mr. Rajiv Agrawal to take the session.
Good afternoon, ladies and gentlemen. We welcome you to this webinar on tax deduction at source, provisions in GST regime. First of all, I begin with thanking Mr. Rao and his team for making this thing possible. GSTN has always endeavored to outreach tax officials and taxpayers for more knowledge dissemination among them. What I'm going to do is that I will cover some of the briefly I will tell about GSTN. Then I will cover about registration, return procedures, and other miscellaneous procedures, which is in GST Act. I will briefly also cover other provisions which are relevant to the tax deductors, like refund or anything related to show cause notice, etc. I will also like to thank my colleagues over here, Mr. Pankaj Arora, who helped in making this thing possible, Mr. Harsh, Mr. KP Verma, Mr. Jagmal Singh, Mr. Shashi Bhushan, Mr. Praveen Kumar, for all their inputs so that this thing has become possible. Thank you very much. And now I will begin. So the first thing we are going to do is that we will go through we will know something about brief about GSTN. So first we should know what is GSTN. GSTN stands for Goods and Services Tax Network. So it's a private limited company under Section 8. So the point was why GSTN was created. So when the government was thinking of implementing GST across whole of India, they thought they surveyed the whole thing. They looked into the landscape of the taxpayer across indirect taxation, and they found out that there are around 70 to 80 lakh taxpayers across the country who will be filing their returns. So government in this particular new regime wanted to capture invoices so that there is a seamless flow of credit from the supplier to the buyer. For this, it was required that invoices should be captured. So it was envisaged that there will be around 300 crores business to business invoices only, which will be captured during GST regime. And there will be more than a lakh of tax officials who will be working into GST regime. There is going to be a monthly filing of the returns, because from those returns only government comes to know about how much taxes have been paid, how much clearances has been made by the taxpayer. Then the tax credit should move smoothly from one part of the country to another part of the country, even within a particular state. Then the government wanted to create certain business intelligence reports, so that if there is a policy formation to be done, then that can also be done. So all that required that there should be a strong IT infrastructure which is independent, in the sense that they are able to take proper and correct decisions on time, and it should have a flexibility of the private sector. Government also wanted to retain the strategic control of the GSTN, this particular SPV. So government created goods and services tax network for that. So as I told you, it's a non-profit, not-for-profit, non-government company. It is promoted jointly by central and state governments. So what GSTN is required to do is that they are going to create a necessary IT infrastructure, so that taxpayer can file their returns and file amendment in registration or refunds or anything. So anything taxpayer wants to do under GST regime will be done through GST portal only. So GSTN has been interested with development of IT infrastructure, as well as they will be developing the software application for it. So all the front-end services of registration, returns, payments, etc. will be developed by GSTN. So in a way, GSTN is an interface between the government and the taxpayer. So a taxpayer, for interaction to the government or to comply with the GST regime, is going to come into GST portal. The GSTN will also look into proper credit settlement between the central and state government, so that taxes are properly accounted for and communicated to the necessary state or central government, and they are given a proper share also. So this visibility will also be provided by GSTN. So GSTN was created as a special purpose vehicle in which the government share is around 49%. 24.5% is of the center and 24.5% is of the states. There are other entities also who are holding share in GSTN, which I will show you later. So the government created GSTN for independence of management and making strategic control with the government, and there is agility in decision making. That's why government created GSTN. So GSTN is going to provide, as you can see on the slide, various services to the taxpayer and to the tax officials, like registration, payments, return filing, then ledger management, settlement of the IGST tax which is being collected, and it will provide MIS reports and to carry out any research or to study any best practices. So as you can see in point number 2, that's how the government has created the GSTN, that through board of directors, government can control GSTN. And government has also allowed certain relaxation in the rules, so that the government officials can come on GSTN on deputation. So we have certain officers from the State Department who have come on deputation to GSTN, and we have 3 officers from the central also who have come to GSTN on deputation. So this the last point shows on the slide the equity structure of GSTN, in which you can see the LIC, Housing Finance, HDFC Bank, etc. are also holding some part of the equity. But still, the strategic control is with the government. In this slide, you see the number of forms a particular taxpayer is supposed to fill up. Like he has to fill up 317 annexures, and he has to fill up 112 forms to tax authority as of now. If he is registered in all the states and central, in center he has to register for central excise and service tax. So that's what he has to fill up. What is expected, if you see in the below, is that there is going to be around 25 forms which he have to submit to the tax authorities only, and that he is going to do only in the GST portal. He need not go anywhere else. He has to submit all these things in GST portal. So that's what the benefit to the taxpayer is going to come. This slide explains the GST IT strategy. As you can see on the left-hand side, the harmonization of business process and formats is being written. That constitutes the front-end process in which the taxpayer is going to come and file their returns, etc. And through IT interfaces, this data will be transferred to the tax authorities who will be actually working on it, and whatever they will be doing or whatever messages or decisions they will be communicating, that will be sent back to the taxpayer. If we see it in a moving format, it will look like this, that the taxpayer comes to the GST portal, he files his application, which is into the GST application, which is stored in the common portal database, and through API interface, it is transferred to the central or state portal. And that thing is stored in the central and state portal, and tax authority, when they communicate any decision and order, that is sent back to the taxpayer. Apart from this, the GSTN is also making an interface with the network of banks and RBIs so that the tax payment is smooth, and there are certain other verification which is being done by the GSTN, like PAN number of the authorized signatory or the directors, that will also be done through income tax database. So they will also be interacting through API interfaces. So that's how the GST IT strategy has been thought of in the GSTN. In the next slide, I'm going to show you the Model 1 states. What are Model 1 states? Model 1 states are those states which will be developing their own backend processes. So what GSTN is doing is that for 27 states, they are developing backend process also. So for all the taxpayers, GSTN is developing the front-end business process, and for 27 states, they are developing backend process. But these are the states like Andhra Pradesh, Maharashtra, Tamil Nadu, Central Board of Excise and Customs. They are developing their own backend process. So we will be transferring all registered data, etc., to these authorities, and the tax authorities will be working on this particular on their own web portal, and they will be transferring data to us for communicating to the taxpayers. So that covers a brief about GSTN. So this will give you a glimpse about why GSTN was created and what is the purpose of the GSTN, what is the strategic control on it. Now we will come to our topic for today, which is tax deduction at source. And any topic which we cover will be incomplete unless we covered certain silent features of the income tax. So what we are going to do is that we are going to cover salient features of TDS provisions in the income tax. So in GST law, it has been provided that in the GST law, the tax deduction at source has been taken in lines with the income tax provisions. So that law that has been studied and in a particular manner has been brought into GST Act now. So what is tax deduction account number or tax collection account number? It's a 10-digit alphanumeric number which is issued by the income tax department. And as per the incomes, whatever we are going to cover in next 3 slides is as per the income tax law. So TAN to be obtained by all persons who are responsible for deducting tax at source or who are required to collect tax at source. So anybody who has to collect tax at source, which is provided by GST law, has to get a TAN, and that TAN is being given by the income tax department. So as per section 203A of the Income Tax Act 1961, every person who collects or deducts tax at source must have a TAN. And it is as per the section 203A of the income tax, it is mandatory to quote TAN in following documents like TDS return, TCS statements, or annual information return, which is filed in the income tax. These are the TAN is mandatory. So, and the income tax provision also provides that the government deductors must have a TAN, and PAN cannot be quoted in place of TAN. So a government deductor has to quote a TAN, and a taxpayer, a taxpayer cannot have more than one TAN. So if we have one office which has to deduct tax at source under GST law, then that office should have one TAN. one TAN with it, and that should be unique. And if there are different branches and different divisions or entities, then they will have separate TAN with them. And in case more than one TAN has been allotted, then the TAN which is being used regularly should be continued, and the other TAN, if there are in with the offices, should be surrendered using the form for changes or correction in TAN. So what we have covered right now are the provisions which is given for TAN in the income tax provisions. So now we are going to do is into the GST provision. We have covered the brief about GSTN and income tax provisions relating to TDS. Now we will cover the GST provision. We will start with registration, and then we will go into returns and other provisions. So the next slide you see is structure of TAN. So the first 2-digit structure of the GSTN number or the TAN number, which will be given to the tax authorities. So the first 2 digit is the state code. So as whatever is the name of the state, that should be the first 2 digits, followed by 10-digit tax deduction account number. 13th is an entity code, 14th is a blank digit, and 15th is a checksum digit. So if you see the structure of the TAN, the first 4 digits of the TAN are alphabets, and the next 5 digits are numeric, and the last digit is an alphabet again. So the first 3 digits represent the jurisdiction code. 4th alphabet is the initial of the name of the TAN holder, who could be a company, firm, individual, or any government authority. For example, if a TAN is allotted to Mr. Mahesh of Delhi, then his TAN will appear like this. So the first 3 digit will be DEL, which will be the state code, a jurisdiction code, followed by first name, his first name, which is Mahesh. M is the first name, followed by 5 numerical digit and 1 alphabetical digit. So if you see, the top line shows the GSTN number, which will be given to a tax deductor of the GST regime. So that's how your TAN GSTN is going to look like, which is completely based on TAN. So what are the provisions of the GST Act which is applicable and which initiates or starts the applicability of tax liability on a particular authority? So the section 51 of the GST Act says that the government may mandate following class of the person. There are 4 class which is mentioned over here. The first class is a department or establishment of the central government of state. So the government may mandate a department or establishment of the central government or state government or any local authority or government agencies. So these are the categories which have been defined in the GST Act. And the last one is a category which is being notified by the government on the recommendation of the council. So this is the 4 categories in which the persons are required to obtain a TAN and get a GSTN registration number. For what? For doing tax deduction at source. So government may mandate these 4 authorities for doing tax deduction at source. This is section 51 of the GST Act. Then section 24(6) of the CGST Act says that persons who are required to deduct tax under section 52 are required to register under GST. So in place of TAN, 25(6) section 25(6) says that in this place of PAN, they have to indicate their TAN. But you remember, in the case of income tax authorities, a provision that has been clearly indicated, anybody who is doing tax deduction at source or tax collection at source, they have to mandatory get a TAN number. Then obtaining TAN number under income tax is mandatory, as we have covered earlier also. And after obtaining TAN, what a tax authority, those 4 tax authorities have to do is this, that they have to electronically submit an application, duly signed. So signature is either to a DSC or through ESC. So after doing that, they have to submit an application for registration under form GST Reg 07. So all the forms which I am mentioning over here are still under discussion. So I will not be able to show you the forms, but I can show you about the various provisions of the GST Act, which is applicable to TDS and which will be shown to you. So the TDS deductee has to come to the GST portal for making a registration application, he has to go to income tax portal to get a TAN number, and then he has to come to a GST portal for getting a GSTN number to comply with the GST regime. So he will apply in the form GST Reg 07 either directly, he can do it directly himself, you create a user ID and password and create that, or he can use a facilitation center notified by the commissioner and use that facility to upload his form for registration. Then that form will be sent to a proper officer, as we have shown in the first part of the presentation. That proper officer will grant registration after due verification, and the certificate will be issued in the form GST Reg 06 within 3 working days of the date of submission of application. And proper officer, if he so wishes, can ask for certain clarification also, which applicant has to reply. And after the receipt of the reply of the applicant, the proper officer has to issue the registration application within 3 days. Now we will cover a slightly bad part of it, cancellation of registration certificate. So the first part does not cover it. The first bullet point is regarding if there is any change in information furnished by the applicant. So if an applicant is there, he is already registered, and there is a change in certain information of the applicant, then he has to submit. Then he has to submit the changes in the information in form GST Reg 13 along with the documents. So if there is any change in the registration certificate or the information submitted, then you have to resubmit using form GST Reg 13. And all these forms will be communicated and will be in the public domain after some time. They are still under deliberation. Now, cancellation of registration certificate is covered under Rule 5.3 of the draft registration rules. So it says that this law is not only applicable to TDS, but it is also applicable to everybody. Like if any application of registration has come, then this Rule 5.3 will be applicable. So it says that if in pursuant to any inquiry or any proceedings under this act, the proper officer is satisfied that the certificate of registration is no longer liable to deduct tax at source under Section 51 or collect tax at source under Section 52, that said officer may cancel the registration issued, and such cancellation shall be communicated in the form Reg 08. So this particular provision, if you see, Rule 5.3 has been drafted in such a manner that this empowers proper officer to cancel registration for TDS or TCS, tax deducted at source or tax collected at source. So this is not applicable to the normal taxpayer as of now. But if you see the provided proviso which is given, that the proper officer shall follow the procedure prescribed under Rule 14 of the cancellation of registration. We are not going to cover that because that is a very specific topic to be covered. But what it basically says is that there is going to be a due opportunity to the applicant or to the registrant to give his point of view. And after receipt of that point of view, the tax officer is going to pass an order. That order will be an appealable order, in the sense that if a TCS or TDS registrant wants that this order is appealable, or he is not satisfied with the order, then he can go and appeal against that particular order. So that's cover the registration parts of the TDS of the GST law. Now we will come under the what is the TDS or the person who has got his registration is required to do. So what he is required to do is that he has to deduct tax at the rate of 1% from the payment made or credited to the supplier in case of intra-state supply. So he is going to deduct 1% of CGST and 1% of SGST. So the total deduction will be 2%. If 2% of the tax. And when the deduction is to be made is that when total value of such supply under a contract exceeds 2,50,000 rupees. So if you are getting a supply of 2,50,000 rupees and such supply is under a contract, then you have to deduct 2% tax on it. 1% of the tax will be CGST and 1% of the tax will be SGST. And you have to deposit this tax in the account of the government. no tax deduction of the source is to be done if the location of the supplier and the place of the supply is in a state /UT different from state UT of the registrant of the application recipient. Now the question arises why this is so. This is so because in such supplies IGST will be applicable, and then we will have to go to IGST Act for the applicability of the tax. So the value of supply, if you see the last point, excludes any central tax, state tax, UT tax, integrated tax, and cess indicated in the invoice. So this amount has to be excluded. When we have excluded all this amount, and then the value of the supply is whatever is the value of the supply, we have to deduct 2% of the tax from that value, and we have to credit this to the government. So that's what the section 51 of the CGST Act says. So as you can see, the similar provision of the tax deduction at source has been given in SGST bill. So there also, and into UTGST bill also. So that's where 1% is mentioned. And in case of interstate supply, the rate of 2% has been mentioned. So that's what we have covered in the last slide also. Then what, after deduction of tax, what is to be done by the deductor? So deductor has to pay this particular amount within 10 days after the month in which such deduction is made in the prescribed manner. So this is section 51(2) of the CGST Act. So CGST Act 51, section 51(2) says that the tax has to be paid to the government within 10 days after the month in which such deduction is being made. So even if supply has been made earlier or supply is made later, if you had made any deduction in a particular month, you actually pay this particular tax into the next month into the government kitty. So that's cover the TDS part. So what we have covered is why you have, how you have to register, who you have to register, and what you have to collect tax on. Now, what we have also covered partly is that you have to give this money back to the government by depositing it by the next 10th of the next month. Now we will cover the written part of the tax deductor. So if you, as you can see, as per section 39(3) of the CGST Act, so every person, registered person who is required to deduct tax at source under section 51 shall furnish a return in form GSTR 7 electronically through the common portal within 10 days after the end of such each month. So if you see, there are a few points into this. First is that those persons, every registered person required to deduct tax at source. So if you are required to tax deduct at source, as per section 51 of the CGST Act, you have to file a return in form GSTR 7. And how you have to file is not manually, but electronically onto the GST portal. And up to what time you have to do? Within the 10 days of the end of the month. So if we are talking about the month of, say, April, I have still 2 more days to file my return, 1 more days to file my return. So I can file my return for all deductions made in April 2017 by 10th of May 2017. So the details furnished by the deductor under sub-rule 1, whatever details are being given by deductor, shall be made available electronically to each of the supplier. So if a tax deductor has deducted tax TDS for 10 of the suppliers, then for each of the suppliers in part C of form GSTR 2A, that particular column and that particular information will be populated. So that's how the supplier will come to know that the tax has been deducted, and he will be able to get this particular information through GSTR 7 being filed by the tax deductor. So that information will flow into GSTR 2A of the person from whom the TDS was collected, and this will appear in his GSTR 2A after due date of filing of GSTR 7, which is the 10th of the following month. Then, as per the section of 51(3), the certificate is to be issued by the deductee to the deductor that this particular amount of has been deducted as tax. So the portal, as per the development of the GST portal, this will be automatically generated, and this certificate will be available to the supplier in the form of GSTR 7A on the basis of the return which is being furnished under sub-rule 1. So what is very important is that the deductor should file GSTR 7 so that the information of the tax deducted at source is communicated back to the supplier, and he's also able to see that deduction at source, tax deduction at source certificate in his GSTR 7A. So as we have discussed, section 51(3) provides that CGST Acts provides that the issuance of TDS certificate to the deductee by the deductor within 5 days of crediting the amount so deducted to the appropriate government. The certificate will indicate the contract value, rate of deduction, amount deducted, etc. And in case there is a failure to furnish TDS certificate to the deductee within 5 days of crediting the amount so deducted to the government, a late fee of rupees 100 per day will be levied until the failure is rectified. So if failure continues for 10 days, then the tax will be a late fee of rupees 1000 will be levied. But if this failure continues for more than 50 days, then even then 5000 rupees only will be levied on the person. So the fee has a maximum limit of 5000 rupees and a minimum rupees of 100 rupees per day. So that's what deductee might have to pay if he's not filing the return, or he's not able to pay up to the government within the time limit provided, or he's not able to provide the deductee the required certificate. So this covers the return part of the TDS. Now we will cover the miscellaneous provisions related to TDS and the GST. So as you know that the TDS has to be paid to the government within 10 days after the end of the month in which the deduction has been made in the prescribed manner. So the prescribed manner is that the deductee will go to the GST portal and he will create a challan, and using that challan he will pay the amount, whether it is CGST, IGST or SGST which has been deducted, or cess which has been deducted. And if there is any failure on the part of the deductor to the payment to pay the amount of TDS to the credit of the government, then interest will also be levied. We will see the provisions of interest later on. And if there is if the amount of default will be determined under section 73 or 74 of the CGST law, so which will also be covered later on. So these are the information which will be a deductor which will be required to file on this. So what he will have to do is that he will have to provide TDS details. Then he will have to provide revision in the TDS details. Then if there is any liability to be paid or which remains unpaid, then refund claimed, or anything which is there which will be shown by the deductor in his returns. Then tax deductor is required to electronically sign the declaration and then submit the return to the GST portal. So this is given so that he certifies that the information whichever is given is correct, and which has been furnished by him is correct. Then return for further period cannot be filed, as you know, as per section 3910 of the CGST Act, if return for the previous period has not been filed. So these are the provisions which are there in the GST Act. So to comply with that, we should be very clear and we should follow each one of them carefully. So how payment of the tax deducted has to be done? So after using a challan, tax is paid to the government. Then that amount will be used for debiting the electronic cash ledger, and automatically the electronic tax liability register of the deductee will be credited. So that's how the smooth flow of the payment module will work. The tax will be paid to the government through a GST portal, and the challan detail will be sent to the bank. As soon as the confirmation is received from the bank, then electronic cash ledger of the deductee will be updated, and after he makes the debit in the electronic cash ledger, the electronic tax liability register of the deductee will also be updated. So that's going to be automatic. So just wanted to let you know that we are going to slightly exceed the time, but I hope that is okay, and we'll request you to continue. So any amount which has been deducted under section 51, as I mentioned, will be claimed by the deductee in the form GSTR2, from whom the said amount was deducted or collected, and will be credited to his electronic cash ledger so that he can use that particular information for making further payments. And if there is a delay payment of tax of the deductee, which is deducting tax at source, then interest up to 18% is liable to be paid as per Section 50 of the CGST Act. Regarding refund, if there is any tax which has been extra collected or deductee is liable for any refund, then he has to apply for refund under Section 51(8) of the CGST Act, and the process under that has to be followed. But the only issue is that only that amount of refund can be asked by the deductor if that amount has not been credited to the electronic cash ledger of the deductee. So if the amount has been if deductee feels that he is liable to refund, but he has shown it in the return and it has been updated into the electronic cash ledger of the deductee, then deductor will not be entitled for a refund as per Section 51(8) of the CGST Acts. So now what we are going to cover is that offenses and penalties. Why we have done is that you should know about it so that you are aware what are the provisions which come into play if such kind of situation happens. Nobody will be deliberate in doing it, but you should be aware of it. So if a tax deductor fails to deduct the tax, so either you have made a payment of 2,50,000 or more and you have not deducted tax at source, and or you deduct an amount which is less, so you're liable to deduct a tax of 100 rupees, you only deducted a amount of 75 rupees, or you have failed to pay the tax to the government, then the amount deducted as tax, whatever amount which was supposed to be paid to the government after you have made the deduction, then you will be liable to a penalty of 10,000 rupees or an amount equivalent to the tax evaded or the tax not deducted under Section 51, or short deducted or deducted but not paid to the government. So there are three aspects to it. One is that tax deductor either failed to deduct or it has deducted the amount which is less, or he fails to the government, then he is liable to pay a penalty of 10,000 rupees or an amount equivalent to the tax which has not been deducted or evaded or not paid up. So that's the offense and penalty section. Then there is a demand and recovery section which is covered in Section 73, which shows that which says that a show cause notice can be issued for demand of amount which is not paid, short paid, or erroneously refunded, or input tax credit has been wrongly availed or utilized. Then this can be done within 3 months prior to the time limit issuance specified for issuance of order, and if there is any subsequent state notices to be issued, then statements can be issued. And if the person who is liable, to whom show cause notice has been issued, he pays up the amount along with interest, then no show cause notice will be served to him. And penalty which has been envisaged in Section 73 is penalty of rupees 10,000 or 10% of tax, whichever is higher. And the order is to be issued within 3 years from the date of filing of the annual return for the subject financial year. And the show cause notice, if you go back to the point number 2, has to be issued 3 months prior to the time limit specified for issuance of order. So this covers Section 74. The difference between Section 73 and 74 is only in the manner of fraud, willful misstatement, or suppression of facts. Like in the first thing, the same thing is there. Like if there is short payment of tax or there is a evasion of tax, but with intention of fraud, willful misstatement, or suppression of facts, then Section 74 comes into play. And there are certain difference in the penalty which can be imposed or the show cause notice which can be issued. So show cause notice has to be issued within 4 to 6 months of the time limit for issuance of order. And the tax amount, penalty amount has also been given that it should be 15% of the tax if it is on the own ascertainment of the party. And even after issuance of notice, he has an option to pay the tax, interest and penalty of the 25% amount within 30 days of the issue of the notice. So this is my last slide. So this covers the transitional provision under tax deducted at source. So where if you see is that where a supplier has made any sale of the goods in respect of which tax was required to be deducted at source under any law of a state or union territory relating to value added tax. So what is happening is that in the current provision, if that goods were liable to tax and any sale of goods has been made under that particular law, and he has also issued an invoice for the same before the appointed date. So if invoice has been issued on 20th of June 2017, which is going to come next month, then no deduction of tax at source under section 51 shall be made by the director under the said section, where payment to the said supplier is made on or after the appointed date. So even if you are making payment after the appointed date, that is the 1st of July, then no tax is to be deducted under section 51. So section 51 excludes certain provisions. One is that the sale has been made. One. Second, it is made under the existing law. And third, invoice has been issued before 30th of June. Then in all three cases, if all three conditions are satisfied and payment is made after 1st of July, then you need not deduct any tax TDS under section 51. That's what the transition provision has been provided for. So that's all from my side. Thank you very much. And I hope that this was very useful to you. So some of the questions have come up. I will answer one or two of them. And then rest of the questions will be replied by to you later on. So is online shopping affected in any way? So first question is online shopping affected in any way? So shopping is on whether the shopping is to be done online or it should be done in any other manner is to be done by the government, like in the sense that the government makes the provision that either you do it through either you can do it through floating a tender or any other way. So that is provided by the government. So you have to do it through the provision which has been guidelines which have been issued by your government, maybe state government and central government. So online shopping is not affected. If you want to order online, you can do that as per the existing provision. But the provision of the CGST, etc., only provides that you have to deduct tax at source of around 2%, 1% CGST, 1% SGST, or 2% of SGST. So that's what you will have to do. And regarding TCS or e-commerce or tax collection at source, that is a separate chapter altogether that is to be done under section 52. So we are not talking about that in this particular date. So how can taxpayer amend his return in case of any error? So amendment section has been provided in the return. So for the next month of return, if he wants to amend, he can amend his details, and that he can do in the next month. So the next question, one of the question is up to how much amount turnover there would be no GST. So this is not applicable in this particular case, as the provision says that if you are getting a supply of more than 2.5 lakh of rupees, you have to make a tax deduction at source. So you have to get registered if you're getting a supply of more than 2,50,000, and if it has been provisioned by the government that you should register, you must register and you must deduct tax. So it is not applicable about the supplier, it is applicable to you. If you are getting any supply of more than 2,50,000, you are supposed to collect a tax deduction of source of 2%. Now, one of the question is which term is used for ITC in GST. So ITC mentions input tax credit, which means that the tax, whatever tax we have been deducting, is available to the supplier for taking as a credit and using that tax for making further payments. So that is input tax credit. So in a normal situation, what happens is that the supplier pays tax, and that tax flows to the that invoice goes to the receiver, and the receiver takes input tax credit of that. So ITC means input tax credit. So that's all from our side. Thank you very much. I hope this was useful to you. I again want to thank Mr. Rao and his team, and my team over here, Neera Tamta, Mr. Pankaj, Jagmal Singh, Praveen Kumar. Thank you very much. Thank you, Harsh, everybody. Thanks a lot. Over to you, Mr. Rao. Thank you very much.
Can I enable it? Thank you, sir. Thanks for this wonderful session. And now, Shalini, could you like to give some inputs?
Thanks for wonderful audience around. Once again, thank you so much for the together learning that we had from this session. There are plenty of questions which are coming around, which with the reference of the time that we have here, we would like to restrict ourselves from here. And the questions will all be answered through that as well. We would like to answer your questions and queries through our KMS portal, and hope you had a good learning. There is a poll which has already been showing on your windows. If you can actually reply to that, it will be helpful for us for giving you a better quality and better delivery next time, as well as the learning is a never-ending journey for each one of us. Good night, Shabak Khair. Have a very good day, whichever is left now. Have a good day. Thank you so much.
Thanks, sir.